Let's delve into the definition of options, but let's ground it in the real world by using a scenario in the real estate market. Imagine there's a piece of land valued at $1 million and there's a buyer interested in purchasing it. However, the buyer isn't entirely convinced about the price and requests the seller to keep the land available for sale at $1 million for the next 3 months. In return for this agreement, the buyer pays a premium of $10,000 to the seller. This premium serves as compensation to the seller for keeping the land off the market for the specified duration. After 3 months, the value of the land increases by $100,000, bringing its new price to $1.1 million. Despite the surge in value, the buyer still has the right to purchase the land at the agreed-upon price of $1 million, thanks to the option contract. However, it's important to note that the buyer's profit isn't the full $100,000 increase in value. Instead, it's $90,000, $100,000 increase minus the $10,000 premium paid. This real estate scenario mirrors the concept of call options in the financial market. Just like in the land purchase agreement, a call option gives the buyer the right to purchase an asset, in this case, a stock, at a predetermined price, the strike price, within a specified period. The premium paid by the option buyer compensates the option seller for undertaking the obligation to sell the asset at the agreed-upon price, regardless of its current market value. In options trading, understanding the perspectives of both buyers and sellers is crucial. As buyers, we gain the right to exercise the option if it's favorable, while sellers are obligated to fulfill the terms of the contract. By grasping these dynamics, traders can effectively navigate the risks and rewards associated with options trading. In the next lesson, we'll delve deeper into risk profiles, starting with stocks, before exploring their application to call options.